It was a Friday evening in September. While most Americans were settling in for the weekend, ordering takeout, watching football, a small group of men in lower Manhattan stared at screens displaying numbers that made no sense, numbers that shouldn't exist. Within 48 hours, these men would make decisions affecting the savings, jobs, and futures of 7 billion people. ATMs across the country came within hours of shutting down. The global financial system, everything you depend on for your paycheck, your mortgage, your retirement, was bleeding out. And almost no one knew it was happening. This isn't conspiracy. This isn't speculation. This is documented history deliberately buried beneath carefully crafted headlines designed to prevent panic. By the end of this video, you'll understand what actually happened during those 48 hours. You'll see the warning signs ignored, the secret meetings that decided your fate, and the desperate measures that saved the system, while planting seeds of the next collapse. 99% of people still don't understand how close we came. After this, you won't be one of them. But to understand how we came to the edge, you first need to see what was building in the shadows before that weekend. In the weeks leading up to that fateful weekend, America felt stable. Housing prices were adjusting, sure, but experts on television assured everyone this was perfectly healthy. Just a correction, nothing to worry about. Newspapers ran stories about the upcoming election. Families planned Labor Day barbecues. The stock market had wobbled, but it always wobbled. That's what markets do. Meanwhile, in corner offices across Wall Street, a very different reality was unfolding. Executives at the nation's largest financial institutions were quietly hiring bankruptcy attorneys. Risk managers who raised alarms were being ignored or silenced. Trading desks that normally hummed with activity were seeing strange, unexplainable freezes in markets that had been liquid for decades. The public saw calm. The insiders saw a hurricane forming just offshore. This is what I call manufactured normalcy. The people at the top understood that confidence is the only thing holding the financial system together. Not gold, not laws, not regulations, just confidence. And once that confidence cracks, everything collapses. Fast. So they maintained the illusion. Press releases were carefully worded. Earnings calls were scripted to sound optimistic. Regulators, who should have been sounding alarms, were instead reassuring Congress that everything was firmly under control. But here's what most people don't realize. The warning signs weren't hidden. They were everywhere, in the bond markets, in the credit spreads, in the overnight lending rates between banks. Professionals saw them, analysts wrote about them, and almost nobody listened. The gap between what the public believed and what the insiders knew had never been wider. Most people were sleepwalking toward a cliff, being reassured by the very voices that knew exactly how close the edge really was. Then, late on that Thursday evening in September, the first crack in the facade appeared, and everything changed in an instant. September 15th, 2008. Lehman Brothers, the fourth largest investment bank in the United States, filed for bankruptcy. It was the largest bankruptcy filing in American history, and it was just the beginning. At 6:47 that evening, traders across Wall Street watched their screens flash red. Lehman's collapse wasn't just one bank failing. It was the thread that, when pulled, began unraveling the entire global financial fabric. Within hours, the panic spread. Money market funds that had seemed as safe as cash were suddenly teetering. Insurance giant AIG, which had written trillions of dollars in derivatives contracts, was hemorrhaging money so fast that executives couldn't calculate the losses quickly enough to report them. One senior executive later described staring at his terminal and feeling, for the first time in 30 years, genuine terror. The numbers made no sense. Models that had worked for decades were spitting out impossible figures. Risk calculations that should have shown manageable exposure instead showed infinite loss. The phone started ringing. London was panicking. Tokyo was panicking. Every major financial center on Earth was watching the same screens and reaching the same terrifying conclusion. This wasn't a correction. This was a collapse. Here's what the public didn't understand then, and most still don't understand now. The global financial system operates on trust. Banks lend to each other every single night to balance their books. It's called overnight lending, and it's so routine that most people outside finance have never heard of it. On that Thursday night, the lending stopped. Banks looked at each other and realized they had no idea who was solvent and who was already dead, so they stopped lending. The overnight market, the invisible plumbing that keeps the entire system functioning, froze solid. Imagine your heart suddenly stopping. That's what happened to the financial system. The blood stopped flowing, and without immediate intervention, death was hours away, not days. While you were watching television that night, the people who run the global economy were making frantic phone calls, shredding documents, and preparing for scenarios that had only existed in worst-case planning sessions that everyone assumed would never be needed. The moment everyone feared had arrived. And the 48 hours that followed would determine whether the world economy survived or collapsed into something not seen since the Great Depression. What happened next would reveal just how interconnected and how fragile the entire global system truly was. To understand how one bank's failure nearly destroyed the global economy, you need to understand how the modern financial system actually works. And here's the uncomfortable truth. Almost nobody does. Not even the people running it. Picture the financial system as a spider web. Every bank, every insurance company, every hedge fund is connected to every other by invisible threads of debt, derivatives, and obligations. When one node fails, it doesn't just affect that node, it sends shockwaves through every connection. Lehman Brothers had tentacles everywhere. They were counterparty to trillions of dollars in derivatives contracts. They owed money to banks in London, Tokyo, Frankfurt, and Hong Kong. And every single one of those institutions had used Lehman's promises as assets on their own balance sheets. When Lehman collapsed, those assets became worthless overnight. Suddenly, banks that had seemed healthy were facing massive holes in their balance sheets, and those banks owed money to other banks, who owed money to still other banks. The dominoes started falling faster than anyone could count. There's a term in finance called rehypothecation. It means using someone else's collateral as your own. In plain English, it means the same assets were being counted multiple times by different institutions. Everyone thought they owned the same things. When the music stopped, they discovered the chairs weren't just in short supply. They didn't exist at all. Within 12 hours of Lehman's bankruptcy filing, more than $4 trillion in assets were frozen or in question. Credit default, swaps the insurance policies banks had written against exactly this kind of failure, were being triggered simultaneously across the globe. And the institutions that had written those swaps, particularly AIG, didn't have the money to pay. The experts had built a system so sophisticated that no one understood it, including them. Risk had been sliced, diced, repackaged, and distributed until it was everywhere and nowhere. When the crisis hit, nobody knew who was holding the toxic assets. They could be on any balance sheet in the world. This is what contagion looks like. Not a single failure, but a cascading collapse where each falling domino reveals 10 more. Banks that had nothing to do with subprime mortgages were suddenly fighting for survival because they'd lent money to someone who'd lent money to someone who'd insured someone who'd made bad bets. Most people still believe the system was saved because it was strong. The truth is exactly the opposite. The system was so fragile, so interconnected, so over-leveraged that a single failure in New York could bankrupt banks in Iceland, collapse construction companies in Spain, and freeze credit for small businesses in every country on Earth. That Friday night, as the chain reaction accelerated, the most powerful people in finance gathered in secret to decide the fate of the world. On the evening of Friday, September 12th, actually 3 days before Lehman's final collapse, the most powerful men in American finance gathered at the Federal Reserve Bank of New York. The building at 33 Liberty Street became ground zero for what would be the most consequential financial negotiations in modern history. Treasury Secretary Hank Paulson, Fed Chairman Ben Bernanke, the CEOs of every major bank on Wall Street. They sat across from each other in wood-paneled rooms, arguing about who would live and who would die. The atmosphere was described by participants as being like a war room, except the enemy was the system they had built themselves. Paulson was clear from the start. The government would not bail out Lehman Brothers. He had already rescued Bear Stearns months earlier, and he was determined to draw a line. Moral hazard, he called it. If the government always saves failing banks, banks will always take reckless risks. But the bankers in that room knew something Paulson seemed to underestimate. Lehman's failure wouldn't just punish Lehman, it would detonate a bomb that would shower debris on everyone. For 2 days, they negotiated. Bank of America was pushed to consider buying Lehman, so was Barclays, the British bank. Numbers were exchanged. Balance sheets were reviewed. And one by one, the potential saviors walked away. The reported conversations from those rooms reveal a mixture of terror and cold calculation. CEOs argued about which competitors they could afford to let fail. Government officials debated how to explain their decisions to a public that had no idea the abyss was opening beneath their feet. Here's what wasn't reported at the time. While these men negotiated, their staffs were quietly preparing for catastrophe. Lawyers were drafting emergency powers documents. Regulators were gaming out scenarios for bank holidays. Someone, and the records are unclear on exactly who, raised the question of whether martial law might become necessary if the ATM stopped working. The narrative you were told on Monday morning was carefully crafted. What actually happened in those rooms was far more desperate. By Saturday evening, it became clear that no private buyer would save Lehman, and the government had painted itself into a corner. Paulson couldn't bail out Lehman without contradicting everything he'd said about moral hazard, but letting Lehman fail might trigger exactly the systemic collapse everyone feared. The British financial regulator refused to approve Barclays' bid. Bank of America had already pivoted to acquiring Merrill Lynch instead, seeing the writing on the wall. Lehman was going to fail. And the people in that room knew that the next 48 hours would determine whether that failure remained contained or whether it would take down the entire global financial system with it. These meetings were never meant to be public. The full story took years to piece together from congressional testimony, court documents, and anonymous sources. And most people have never heard it. By Saturday evening, those in the room realized they were staring into the abyss, and it was closer than anyone wanted to admit. On Sunday, September 14th, the men who had spent the weekend trying to save the system finally confronted the magnitude of what they had unleashed. Hank Paulson later admitted to Congress that he was genuinely afraid the entire American banking system was going to collapse. Ben Bernanke, the Federal Reserve chairman and a scholar of the Great Depression, told lawmakers behind closed doors that if they didn't act immediately, there wouldn't be an economy to argue about by the end of the week. These weren't exaggerations designed to extract concessions. They were the genuine assessments of the most informed people on the planet. Here's how close we actually came. AIG, the insurance giant, needed an $85 billion bailout within 48 hours of Lehman's failure. And even that wasn't enough. Without that emergency injection, AIG would have defaulted on trillions in derivative contracts, triggering obligations that would have bankrupted every major bank in America simultaneously. Think about what that means. Not one bank failing, not two, all of them. At the same time, contingency plans were being drawn up for scenarios that read like dystopian fiction. Government officials discussed guaranteeing only the first $250,000 in bank deposits, meaning anyone with more than that might wake up to find their money simply gone. There were conversations about declaring bank holidays, freezing accounts, and preventing withdrawals. If Monday morning had arrived without a solution, millions of Americans would have woken up to find their bank accounts inaccessible, their credit cards declined, and their employers unable to make payroll. The grocery stores you depend on require working credit lines to stock their shelves. Gas stations require electronic payment systems to operate. Hospitals require payroll systems to pay their nurses. All of it was within hours of grinding to a halt. This wasn't hypothetical. The machinery was breaking down in real time. The repo market, the overnight lending facility that keeps the entire system liquid, had frozen solid. Banks were hoarding cash. International trade was seizing up. The ports of Long Beach and Newark were about to stop processing shipments because the letters of credit that finance global trade were no longer being honored. The margin between the world we know and complete economic collapse was measured in hours, maybe less. In the final hours of that Sunday, a desperate solution was forced through, one that would save the system, but at a cost we're still paying today. On Sunday night, with Lehman's bankruptcy now inevitable, the focus shifted to preventing complete systemic collapse. And what followed was the largest government intervention in financial markets in American history. The Federal Reserve opened emergency lending facilities that had never existed before, creating trillions of dollars out of thin air to backstop failing institutions. AIG received its $85 billion lifeline. Money market funds received government guarantees. The rules that had governed finance for decades were rewritten in a matter of hours. Treasury Secretary Paulson went to Congress days later and demanded $700 billion in emergency authority. He delivered his request on a single sheet of paper, 3 pages of legislation that gave him essentially unlimited power to buy toxic assets from failing banks. When asked what would happen if Congress refused, the answer was clear: economic Armageddon. Congress initially rejected the bailout. The stock market crashed 778 points in a single day, the largest point drop in history at that time. Days later, terrified legislators reversed course and passed what became known as TARP, the Troubled Asset Relief Program. But here's what the official narrative leaves out. The institutions that created the crisis were rescued with public money. The executives who made the disastrous decisions kept their jobs, their bonuses, their beach houses. Meanwhile, the people who lost their homes, their jobs, and their life savings were largely left to fend for themselves. The government spent $700 billion through TARP. The Federal Reserve committed trillions more through lending facilities that were kept largely secret from the public. When journalists later sued to reveal who received the money, they discovered that banks had borrowed from the Fed at near zero interest rates, while charging consumers double-digit rates on their credit cards. You were never asked to vote on these decisions. They were made for you in rooms you'll never enter, by people whose names you'll never know. And those people made a choice. Save the banks, ask questions later. The decision makers faced impossible choices. Without intervention, the collapse would have devastated ordinary Americans, even more than the recession that followed. But the way they intervened, who got saved, who didn't, and who paid the price, revealed everything about whose interests actually matter when the system faces existential crisis. The crisis was contained, but the consequences were just beginning, and they're still unfolding today. The official story is that the bailouts worked, the economy was saved, the financial system was stabilized, and everyone moved on. That story is incomplete at best, deliberately misleading at worst. What the emergency measures actually created was a financial system more fragile, more concentrated, and more dangerous than the one that nearly collapsed in 2008. Start with the banks themselves. Before the crisis, people worried about institutions that were too big to fail. After the crisis, those same institutions are even bigger. J.P. Morgan absorbed Bear Stearns and Washington Mutual. Bank of America swallowed Merrill Lynch. The survivors didn't learn caution. They gained market share. Then consider what the Federal Reserve did to save the economy. They dropped interest rates to zero and kept them there for years. They printed trillions of dollars through quantitative easing. They deliberately inflated asset prices to make people feel wealthier. It worked if you already owned assets. Stock portfolios soared. Real estate prices recovered and then exceeded previous peaks. The wealthy got wealthier. But if you were a young person trying to buy your first home, you watched prices climb out of reach. If you were a retiree depending on savings account interest, you watched your income evaporate. If you were a worker whose wages barely kept pace with inflation, you watched the gap between you and the wealthy become a chasm. Since that weekend in 2008, wealth inequality in America has reached levels not seen since the 1920s. The Federal Reserve's balance sheet has grown from $900 billion to over $8 trillion. The national debt has more than tripled. And the moral hazard that Hank Paulson worried about, it's now built into the system. Banks know, with absolute certainty, that if they get big enough and take enough risk, the government will save them. The profits are private. The losses are socialized. The crisis was solved, but the underlying problems were never fixed. They were papered over, postponed, and allowed to grow. The same derivatives that nearly destroyed the system are still traded in massive volumes. The same rating agencies that slapped AAA ratings on toxic garbage are still the gatekeepers of bond markets. Most people believe that chapter is closed. The insiders know better. They're already preparing for what comes next. Which raises the most important question of all. Could this happen again? The answer is more disturbing than you think. In September 2019, something strange happened in a corner of the financial markets that most people have never heard of. The overnight lending rate, the same mechanism that froze in 2008, suddenly spiked from 2% to 10% in a single day. The Federal Reserve had to inject $75 billion in emergency liquidity, then another $75 billion. Within weeks, they were pumping hundreds of billions into the system, and this was before anyone had heard of COVID-19. The official explanation was a technical glitch, a confluence of tax payments and bond settlements that temporarily drained reserves. Nothing to worry about. But the people who actually understood what was happening weren't so sure. The plumbing of the financial system was seizing up again, and no one could explain exactly why. This is the reality that the headlines don't tell you. The financial system isn't stable. It's stabilized, held together by constant intervention from central banks around the world. The moment that intervention stops, the cracks start showing immediately. Look at what's happened since 2020. The Federal Reserve printed more money in 2 years than in the previous century combined. Interest rates went negative in Europe and Japan. Governments borrowed like there was no tomorrow because, with rates at zero, borrowing was essentially free. Now rates are rising. The era of free money is ending, and the system that was built on the assumption that money would always be cheap is starting to creak under the strain. In 2023, 3 major American banks collapsed in a matter of weeks: Silicon Valley Bank, Signature Bank, First Republic. Each failure followed the same pattern: a sudden loss of confidence, a digital bank run, and a desperate scramble for government intervention. The FDIC had to guarantee deposits beyond the legal limit. The Federal Reserve had to create yet another emergency lending facility. The playbook from 2008 was dusted off and deployed once again. The headlines say the economy is strong. The bond market, the repo market, and the insiders tell a different story. Sovereign debt levels are at historic highs. Commercial real estate is facing a wave of defaults. Derivatives exposures have actually grown since 2008, not shrunk. The same interconnections that nearly destroyed the system 15 years ago are still there, just wearing different masks. The next 48 hours that shake the world could come at any time. Most people won't see it coming, just like last time. The normalcy bias that kept people calm in August 2008 will keep people calm right up until the moment it's too late to act. But now you know what to look for. So what can you actually do to protect yourself if, or when, the next crisis hits? The 2008 crisis taught a brutal lesson to anyone paying attention. The system will protect itself first, and you second. When the next crisis hits, and there will be a next crisis, the playbook will be the same. Emergency meetings behind closed doors, decisions made without your input, and a scramble to preserve the institutions that the powerful deem essential. Your job is to not be caught completely dependent on that system when it breaks. First, understand liquidity. When markets freeze, cash is king, not cash in a brokerage account, not cash in a money market fund. Actual accessible liquidity that you can reach within days, not weeks. The people who suffered most in 2008 were those who had wealth on paper but couldn't access it when they needed it. Second, diversify your counterparty risk. Most people have their checking account, savings, and investments all at the same institution. If that institution has a Silicon Valley Bank moment, you could wake up locked out of everything. Spread your assets across multiple banks, multiple jurisdictions, and multiple asset classes. Third, reduce your dependence on any single income stream. The crisis didn't just hurt investors, it destroyed jobs across every sector. Having skills that remain valuable during economic contraction, having relationships that can open doors, having the ability to create income outside traditional employment, these are the real insurance policies. Fourth, own hard assets. Real estate, commodities, and yes, precious metals aren't just inflation hedges, they're assets that exist outside the digital financial system. When confidence evaporates, physical things matter. While the public panicked in 2008, insiders were buying distressed assets at pennies on the dollar. They had liquidity, information, and a plan. You can have the same if you prepare now. The window to prepare is always before the crisis, not during. Those who wait for confirmation will find that by the time the danger is obvious to everyone, the exits are already crowded. Those who act now will be positioned to survive and even thrive when others are blindsided. Let's bring it all together and talk about what this really means for you going forward.